If options feel confusing, it is usually because two ideas get mashed together. First, call or put. Second, buy or sell. Those are separate decisions. Once you separate them, the whole map gets easier. Today, we are going to build the 4 basic option positions without jargon. Buy a call, sell a call, buy a put, and sell a put. Start with the buyer's point of view. A call gives the buyer the right to buy at the strike price. A put gives the buyer the right to sell at the strike price. That is the cleanest first layer. Call, right to buy, put, right to sell. But that only describes the buyer. Every option has another side. If one trader buys a call, another trader sells that call. If one trader buys a put, another trader sells that put. The buyer gets a right. The seller may take on an obligation. Position 1. Buy a call. Imagine XYZ is at 100. You buy a 105 strike call for $2. That gives you the right to buy XYZ at 105 before expiration. Why would someone do this? Because they think XYZ may rise. But the stock does not just need to rise above 105. In this simplified example, the option cost $2, so the expiration break-even is 107. Strike price 105 plus $2 of premium equals 107. If XYZ finishes below 105 at expiration, the call expires worthless, and the buyer loses the premium. If XYZ finishes at 106, the call has $1 of intrinsic value, but the buyer paid $2. That is still a loss overall at expiration. If XYZ finishes at 110, the call has $5 of intrinsic value. After subtracting the $2 premium, the buyer is up $3 per share before fees. Now look at the other side. If someone buys that 105 call, someone else sells it. The call seller receives the $2 premium. But in exchange, the seller may have to sell XYZ at 105 if assigned. If the seller does not own the stock, this can be very risky because the stock price can keep rising. At expiration, if XYZ stays below 105, the call may expire worthless and the seller keeps the premium. If XYZ goes to 110, the seller's obligation to sell at 105 is painful. The option is worth 5, but the seller only collected 2. That is a $3 per share loss before fees. And if XYZ goes much higher, the losses can keep growing. Position 3. Buy a put. XYZ is at 100. You buy a 95 strike put for $1.50. That gives you the right to sell XYZ at 95 before expiration. Why would someone buy this? They may think XYZ will fall, or they may own XYZ and want protection. At expiration, the break-even is the strike minus the premium. 95 minus 1.50 equals 93.50. If XYZ finishes above 95, the put expires worthless, and the buyer loses the premium. If XYZ falls to 90, the put is worth $5. After subtracting the $1.50 premium, the buyer is up $3.50 per share before fees. Finally, sell a put. The put seller receives the $1.50 premium, but the seller may have to buy XYZ at 95 if assigned. This is why selling puts is sometimes used by investors who are willing to buy the stock at a lower price. But the key phrase is willing to buy. If XYZ crashes to 70, being obligated to buy at 95 is not a tiny problem. The premium helps, but it does not erase the risk. At expiration, if XYZ stays above 95, the put may expire worthless, and the seller keeps the premium. If XYZ falls below the break-even of 93.50, the seller starts losing money overall. Now put all 4 positions together. Buy call, right to buy, usually a bullish defined risk trade. Sell call, obligation to sell. Can be income-oriented, but uncovered risk can be very large. Buy put, right to sell, usually bearish or protective with defined risk. Sell put, obligation to buy, can be income-oriented or a stock entry strategy, but the downside can be significant. This is why calls are bullish and puts are bearish is too shallow. Buying a call is bullish. Selling a call is often neutral to bearish. Buying a put is bearish or protective. Selling a put is often neutral to bullish. The option type matters, but the action matters just as much. Here is the trade-off in plain English. Buyers pay premium for a choice. Sellers receive premium for accepting an obligation. That does not mean buyers are always smarter, and it does not mean sellers are always taking reckless risk. It means the risk shape is different. Buyers need enough movement soon enough to overcome the premium. Sellers can benefit if the option loses value, but they must respect the obligation they accepted. One word you will hear often is assignment. Assignment is what can happen to an option seller when the buyer exercises their right. If you sold a call, assignment can mean you have to sell shares at the strike price. If you sold a put, assignment can mean you have to buy shares at the strike price. Assignment is not the only way options end. Many traders close positions before expiration, but assignment risk is real, especially for short options, around expiration, and around dividends for some call positions. For now, remember this: buyers decide whether to use the right. Sellers need to be prepared for the obligation. Before we recap, here are 3 mistakes to avoid. Mistake 1: thinking a cheap option is automatically a good deal. Sometimes an option is cheap because the market thinks the odds are low. Mistake 2: ignoring the premium when calculating break-even. If you buy a call, the stock needs to rise past the strike plus the premium by expiration. If you buy a put, the stock needs to fall below the strike minus the premium by expiration. Mistake 3: selling options without understanding the obligation. Premium feels nice when you receive it, but the trade is not over when the cash appears in the account. Let's lock it in. A call gives the buyer the right to buy. A put gives the buyer the right to sell. Buying an option means paying premium for a right. Selling an option means receiving premium and possibly accepting an obligation. Buy call, right to buy. Sell call, possible obligation to sell. Buy put, right to sell. Sell put, possible obligation to buy. In the next lesson, we will take this into the real-looking part of the market, the options chain. That is where you see strikes, expirations, bid, ask, volume, open interest, and the prices that make these contracts tradable.